marks, you should be getting something towards the end of Monday, if not earlier. That would sort of indicate your marks. But other than that, the marks are looking okay. And yeah, so just sit tight, and your marks will be out soon. Don't. I think the best thing to do is wait patiently for it, but also keep in mind that you've also got other assessments that are coming up, and that you should probably consider spending more time on those assessments. Okay. Okay, so guys, this is the fifth lecture in the series on employee benefits. If you remember in the previous lecture, we considered this slide here, which is the bonus provision and profit sharing slide. So in the bonus provisions, we said that a very important part of it is your formula. And I mentioned to you that the formula will always be written in the question. It's your job to read and then carefully understand how to compose the formula, because the formula wouldn't be written in like a sum format. It's going to be in writing. And today's example that we're going to consider today in class is going to sort of demonstrate what I'm talking about, where the formula isn't really in a written mathematical formula. Instead, it's more of described. It's in writing, so it's described. Yeah, just like always, if you have any questions, please feel free to put up your hand, pop something in the chat. If you are not planning to speak, please don't put on your microphone. That's normal. Announcements for today. I already mentioned that your test should be out by latest Monday, 5 o'clock. But the other thing that's very important is online homework. So online homework has opened. 8 questions, not too difficult. You get unlimited time to complete, but you only get 2 attempts. Okay, so again, I'll say that again. You get unlimited time to complete, meaning you can read through the questions and go through them for as long as you want. But once you end an attempt, you only get 2 of those types of attempts. Okay, so make sure that you take your time, read through it, and go through it properly and get the marks. Your highest attempt will be taken. So the amount that's the mark that you get that's the highest will be considered when we compiling your year mark. The other thing is, oh yes, so a lot of what you're going to find in your test as well as your online homework is going to come from something that we did in the lecture. So please try and attend your lectures as well as go over your slides. And then if you have questions about whatever we've done, then you must obviously ask in the consultations or during the lectures. So please just keep that in mind just before you do your online homework, that it's probably a good idea just to go over all of your prior lecture slides. Okay. Yeah, so let's get into today's lecture. So we're going to be looking at the green book, this book here, the green book. And in that book, we are looking on page 312, and we want to consider example 11.6. So I've put up the important bits of that example on your slide today. Basically, what's happening is so I'm just going to give you a synopsis now, and then we'll have a look at the answer. So we look at this company, there's 18 gardeners, right? So 18 workers that are considered gardeners, and then we've got 10 people that are administrative staff, and then 2 managers. Now, notice how the information is handed over to you. It's again in writing, and you, as the student, need to compartmentalize it in your head and realize and identify that these are categories that the examiner is talking about. Okay, so they're giving you categories. They're saying gardeners is one category, administrative staff is another category, and managers is the different category. So you need to identify them as that. Then I'm going to start reading in the middle of the page. You're going to see towards the bottom of the page, it says bonuses and then brackets cash, right? On your slide, it is, so I've just cut that portion out and I've pasted it here where you can see the blue line appearing now. So what it says is bonuses, in brackets cash, are paid out at the end of December and are calculated on the number of service years per employee as follows. So we've got the categories of employees at the top, right? And those are gardeners, administrative staff, and managers. Now we're getting the buckets, what I like to call buckets of different bonuses. So how the bonuses are calculated. Now remember, it is your task as students to be able to read this and identify that, you know, one is categories of employees or workers, and the other one is sort of categories of bonuses that can get paid out. And see the table that's just below there, the dots are appearing next to that table. You're going to see how nicely the examiner here has written it out for you, and they sort of tabulated it in such a way that it's easy to understand. As students, we need to be prepared for us not to get this type of table, right? So it's not always going to be in our questions. We need to be able to read the question and create this table on our own. Okay, so it says, for example, you know, there's gardeners going down, and the gardeners are split up into 5 that have been here for 1 to 5 years, and then 8 for 6 to 10 years, and then 5 of them are over 10 years, so they have over 10 years of service. And they've done the same thing for administrative personnel and managers. And then there's little asterisks. I don't know what the plural for asterisk is, but whatever it is, those things are there. And you can see the 3 little blue dots appeared next to them. And basically, there's notes relating to those things. So let's have a read of the notes. So if you have your textbooks, it's on page 313, at the top of 313, where the example continues. It reads, including 2 workers who started working on 1 July 2013, are entitled to 50% of the year's allocation. So that 5, you see the asterisk is next to the 5 under gardeners, the 5 gardeners that started 1 year ago and haven't completed 5 years. They're saying within that 5, there's 2 that have started this year, right? There's 2 of them that started this year, and they started halfway through the year. So they've only been around for 6 months. So we need to prorate the bonus for those 2. They can't earn the full year's bonus. They have to only earn for the years that they were here and the years that they were working. So we need to prorate it by 50%. The next asterisk, or the hash symbol there, reads just below, again on page 313, just below that, it says, including 1 worker who started on 1 December 2013, entitled to 1/12th of a year's allocation. So he's obviously started 1 month ago, and therefore he should only earn the bonus for that 1 month, right? Then it goes on to read, so again, I'm reading on page 313. It says, bonuses are thus paid pro rata if an employee has worked for less than a year, which is what we've just learned now about these different employees. The 3 employees who were employed during the current year took their full pro rata leave balances. Okay, that's dealing with leave. For our purposes today, we're not going to deal with leave or basic pay. We just want to focus in on bonuses because that's what we're here for, right? So how would we calculate the bonus? Now, very sneakily, what the examiner has done is you're going to see a line appearing now that's boxing up some numbers, and these numbers are actually yearly numbers. So you'll see that it says there it's the basic salary per employee per year, right? So that's a yearly number. But then when they look at how they broke up the different bonuses, we come here and it tells us it's 100% of the monthly basic salary. Right? So that's going to catch some students out. Let's hope it's not us, right? So that's going to catch some students out because they're not going to remember to divide the 70,000 and the 120 and the 220 by 12 to get a monthly amount, and then work out the bonus. So the bonus is based on a monthly amount. And then, like we were saying, the monthly amount, the bonus increases based on the years of service that they have. So if we were to look at the gardeners, if we were to look at the gardeners and we looked at just 1 to 5 years, right? Just those 5 people that have been here for 1 to 5 years. Immediately, we need to remove 2 of them because 2 of them only started in the current year, and we can prorate that separately. Okay, so we left with 3. Right? So we've got 3 employees, and we're going to take 70,000 divided by 12, which is going to give us a monthly amount. And then we're going to multiply that by 100, which 100%, which doesn't really make sense because it's already, it just means it's the amount that we got. It doesn't change the amount at all. And then we're going to multiply it by 3 because we have to pay 3 employees. When it comes to those 2 people that started in the middle of the year, we're going to have to do a similar thing, 70,000 divided by 12 times 100 times 1. And then after times 1, we must now only give them 6 months of the 12 months because they've only been here for 6 months. So we divide it by 50% or divide it by half at least. And then we get an amount. So let's have a look at what that calculation looks like. So if we have a look here, so at the top of the slide, I've just reproduced what we've already discussed. But if we look here, what's happened is they've taken the 70,000. So this is the 70,000 here. They've divided it by 12, which is 12 months in the year, and they get 5,833. Cool. That's simple. We all got that, right? And then they times that by 1, which doesn't change the amount at all. And then they multiply it by 3 people because there's 3 people that they need to pay. So the provision that we're going to raise for those 3 people is 17,500. We can do the same thing with the 2 people that started in the current year. So we multiply it by 2, but because they've only been here for 6 months, we divide that, or we multiply it by 6 over 12, and then we get 5,833. We do a similar thing for 6 to 10 years when it comes to the amount. So we take 70,000 divided by 12, but then it changes and we stop doing the same thing when it comes to calculating the actual bonus. And so we, instead of multiplying it by 1, we're going to multiply it by 1.2 because it's 120%, right? So when you guys are dealing with percentages, don't get confused because you'll often see me, I'll take 70% and it'll become 0.7 or that sort of stuff. So you guys know how I've done that. So just, if you don't, then just ask, right? And then obviously they multiplied by the 8 people that are there. And so they got their amounts from the table. And that gives us 56. Same sort of story with the 10 plus years. It's 5 times the monthly amount times by 150. And that gives us a total of 43,750. They add all of these amounts up. So the 17,000, let me put this in a different color so that you can follow. They put the 17,000, so that plus the 5,833 plus the 56 plus the 43,750, and then they get the amount at the bottom. Okay, So that's how they actually got this amount. So this is the provision only for gardeners. Okay, very important, because when you're doing a lot of sums, then you at the end of the sum you think, oh, I'm done. But you've only done it for gardeners. So please don't make that mistake. I've seen it so many times in questions, in students' attempts at least, where because the sum seems a bit long-winded, they do the sum and then they think, oh, I'm done now, but they're actually not done now. So please, please, please don't make that mistake. You've only calculated for gardeners, right? And that's why this table says gardeners there, right? So let's have a look at what the calculation looks like for the administrative staff, right? So the admin people. So if we have a look at the admin people, again, very similar to sort of what we did with the gardeners. We take the yearly amount, which is 120, divided by 12. So we get a monthly amount of 10,000. After we get that 10,000 Rand, we then need to multiply it by the number of people that are there. And there's 2 people there. Remember, there's 3 in total, but one started in December. So one started 1 month before the year end. So we going to do that guy separately, right? So we take the 3, we minus that one that started late, and we've got 2, and then we multiply that 2 by the 10,000 Rand. And that needs to be multiplied by 1. Obviously, it's not shown in this calculation here because it's silly to show that the amount stayed the same. Anyway, when we come to the prorated individual, we are now taking the 10,000, multiplying it by 1 individual because there's 1 person, and then we multiply that by 1/12, so 1/12, and we get 833 Rand. Again, same situation. We got the 10,000 because we divided the yearly amount by 12. There's 3 workers, and we multiplied by 1.2 because we were told to. We get 36, and same sort of story with the more than 10 years people. 4 people were included, and we had multiplied by 150. We get 60,000. So we add all those amounts up. So the 4 amounts that are here. Again, let me change my color probably back to red would be a good idea. So we say 20 plus 833 plus 36 plus 60 is then going to give us 116,833. Okay, so why am I, 116,833. Why am I confused by that number? So that's the amount that we're going to get. The managers happen to be very easy. The table did change, but the calculation is the same. And the managers are very easy, and so basically what the managers are is just 220 divided by 12. We get an amount per month. We know that there's 2 employees there, so we multiply that amount by 2 and 150 because they've all been here more than 10 years, and that's 55. Now we're going to add all of those amounts together. So the amount from the first table, which was 123,083, and then 116,833, and then the 55. We then are going to end up with an amount of 294,316. 916. So that amount is the amount that's going to be journalized. That's the amount that we're raising as either a liability or the amount that we're actually paying out. So in the cases where we're not paying it out, it's going to be called a bonus provision. In the cases where we are paying it out, then we are wanting to credit bank, right? So in this scenario, it's the actual question didn't ask for it, but we want to just show you what the journal entry looks like. And that journal entry is going to look like the expense account. So in the past, we used to call this expense bonus paid or bonus expense, right? Sometimes we would have sent it to salary expense. But remember now that we know about employee benefits, we have to be smart and call it something else. And so the something else that we're going to call it is short-term employee benefits. So we're going to increase that expense because the money is being paid, the bonus is leaving. And then most of the times we're going to raise it to a liability, but in this case, we are actually paying it out immediately. And so we're crediting bank for that amount. Any questions on that example? Right, so the takeaways, the stuff that we need to get, right, is that the formula was there. So the formula is this. When I talk about the formula, I'm talking about these things, right? So whatever was happening in these in these blocks in the table, and even the previous tables. So the formula was there, but it wasn't written out. We had to read it and decipher the formula. Okay. So can you do that? I'm not talking about us giving you this formula. So you're not going to get this formula in the test, right? But there's going to be something like this where the formula is in writing and you then need to now compose it and sort of recompose it at the other end. So please read very carefully. Please be deliberate in the way you're trying to understand it, and try and keep track of the numbers and which employees and what year and that sort of stuff. So yeah, so I mean, it definitely depends on the type of question that you get in the test. But yeah, if you read very carefully, I'm sure you'll handle it. Okay. Right, so let's have a look at disclosure. So this was something that we were supposed to do in lecture 4, but we're just going to cover it very briefly now. So any questions on the example, please feel free to pop it in the chat. But while you're busy doing that, just also listen to what I'm saying about disclosure. So in terms of employee benefits, there's no specific disclosure. Remember, the stuff that we have been raising so far is gross salary, which sometimes we call basic. Okay, so the words gross and basic are interchangeable. Okay, don't get confused. Gross and basic are interchangeable, but when you take either gross or basic and you take out the workers' deductions, you end up with something called a net salary. Okay, so that formula stays the same, or that sort of thing stays the same. So far what we've done is we've done the recording of gross salaries, then we did the recording of the company's contributions or the employer's contributions. Then we also had a look at raising that leave pay provision, and now we'll have a look at creating or raising the provision on bonuses. So for the most part, we've only been passing journal entries. Yes? And that's sort of going to stay, that's sort of the topic, that's how this topic is structured. For the most part, it's journal entries. So there isn't a specific note on employee benefits. However, in the profit before tax note, which is a note that I'm sure you guys are familiar with, generally a short-term employee benefits is listed separately, and then we've got that post employment benefits, which is also listed separately. So that is where these amounts are going to come, and that's where they're going to appear, is in the profit before tax note. In some cases, you might even see it on the face of the income statement, but generally on the face of the income statement, the short-term employee benefits and the post-employment benefits are grouped and aggregated is the correct word, is aggregated into an amount called other expenses, and sometimes it's called employee benefit expenses, not always. But I would suggest that you look out for other expenses. Okay. And the only sort of place you're going to see it in the notes is in the profit before tax note, which is what I said already. Now, there's another IFRS. It's called IAS 24. Okay. So IAS 24 talks about the payments that are given to key personnel, right? So the payments to the important people. And that IFRS tells us that those payments or that remuneration must be separately disclosed. Now, if you guys can quickly tell me in the chat why you think it must be separately disclosed. Why do you think that, and now I'm just going to explain a little bit about who is key management. Key management generally are prescribed officers in South Africa, which is mandated by the Companies Act. They have this thing called prescribed officers. And prescribed officers can represent the company in certain respects. Directors are also key management personnel because they make influential decisions, right? They make decisions that change the way the company operates. And then there's another thing called the company secretary. The company secretary is not the person that answers the phone. Okay, it's not the person that answers the phone. Generally, a company secretary is a qualified lawyer, and they deal on the company's behalf in a legal sense. So they are dealing with the legal side of things, right? And so there's actually a qualification called, and you can become a chartered company secretary. So it's actually quite a respected profession. So why do you guys think that these people, their salaries need to be disclosed separately? What exactly do you think is the reason for that? Do you want to just pop something in the chat and tell me why you think that is the case? Okay, someone sent me a private chat. They're saying because they're important. Yeah, because they're important. That's why they need to be disclosed separately. I think also they need to be their salaries need to be disclosed separately because generally they are absorbing the most amount of salary. Their salary is the largest, and because they take a lot of risk. And because of that, it would be beneficial for the stakeholders and the shareholders to know what these people are taking home, what is the amount that they're taking out of the company. Okay, so yeah. Let's have a look at some of the disclosure examples, right? So partly materiality, but also because they are, it's more a function of their role. Because they control the company, because they control things like salaries, right? So these are the people that make decisions about how much to pay people, but they're also making decisions about how much to pay themselves. So it's that sort of, as a check and a balance, that's why we want to know what they're earning. Anyway, so we raised all these liabilities, right? So think about the liabilities that we raised from the first lecture to now. We raised things like medical aid payable, right? And in the medical aid payable, remember we put the deduction from the worker as well as the contribution from the company. So we put that there. Then we've got provident. We put the deduction from the worker plus the contribution from the company. And remember, we call that contribution a post-employment benefit, right? Then we've got, so that was provident. Then we had things like UIF, where again, deduction from the worker and as well as the company's contribution, and then tax, which is just the worker. So PAYE in this section is just the worker, no contribution from the company there. But so we created all of these liabilities that the company now needs to pay soon after the month end. So soon after they've paid the worker, they now need to pay all these other, what they call third parties, okay? Those liabilities are going to be sitting on our balance sheet in our trade and other payables, right? And so I've shown that as an A. And I said this amount will generally be broken up in the notes, the trade and other payables note, which you guys know about. And generally, these amounts will be there, so you can actually go to that note and it'll be broken up, and it'll show, you know, so much needs to go to the medical aid, so much needs to, so all of those liabilities are not going to have a separate line item on the income statement, or at least on the balance sheet. Instead, they're going to be grouped into trade and other payables. So they're just going to be one of the trade and other payables, right? Then when it comes to the income statement, again, there's no specific line item, but again, it's going to be grouped in a thing called other expenses. I told you sometimes if salaries is massive, and that's generally in South Africa, where you've got like mining companies, where the biggest cost tends to be something like salaries, because there's so many workers and they're all risking their lives, so we need to pay them well. So because of that, that balance is going to be like the biggest balance on the income statement. So from a materiality perspective and from a usability perspective, we want to try and put that amount on the face of the income statement. So in that situation where salaries is the biggest amount sitting on our biggest expense on our income statement, then generally it wants to have its own line item, and we sometimes call that line item employee benefit expense, right? And inside there we'll have post employment benefits and short-term employment benefits. But generally in most companies where the salaries aren't the most biggest expense, generally cost of sales is the biggest expense. And so what you're going to see is that those post-employment benefits, as well as the short-term employee benefits, are actually sitting in this account called other, or actually sitting in the line item called other expenses. And then there's an other expenses or profit before tax note, where it will be broken down and showed individually. Okay, so let's have a look at what that note might look like. So this is what our profit before tax note will look like. And so we'd have, in this note, we'd have our short-term employee benefits, and then we'd have our post-employment benefits. And in our post-employment benefits, remember, we've just only got the company's contribution. Why don't we have a contribution for the worker? Well, because the worker's contribution was actually included and came out of his gross salary. So therefore, it's correct. So the person has answered in the chat. Therefore, that deduction from the worker is actually sitting in short-term employee benefits already. And so therefore, we don't need to sort of split it, and if we did, we would be double counting, obviously, right? So therefore we keep it in the short-term employee benefits, because technically we've paid the worker all of the gross salary, but then we also, via agreement with the worker, we've said part of your gross salary you have to put towards retirement, and so they've agreed to that. And so therefore, when we calculate and record our gross salary and cost to company, that contribution for the workers' side of Provident is sitting in there, so we don't account for it again. So this amount where the three red dots have appeared, that amount is just the company's contribution, okay? Because remember, the company's contribution is a little bit over and above the gross salary, so it's not included in gross salary. So therefore, it's sitting here. In terms of this amount where you can see, I don't know what that is, where you can see the little design arrived there. So that amount is including all of the employee or workers' contributions, plus any other contributions that the company made, and also obviously the net salary. So when you are doing your work, right, when you are um, preparing this note, a test for you to do is for you to take the cost to company, okay? Then you remove the provident, and remember the provident or the defined contribution plan is going to be sitting in post-employment benefits, right? So we remove that amount, and we're going to obviously see it where the three dots are. So under the heading post-employment benefits. So we're obviously going to see it there. And then the remaining amount of cost to company plus any accruals that you created. So the leave pay accrual, any bonus accrual or bonus paid, any profit share. When you add all of those up is the amount that you're going to get for short-term employee benefits. So those are the types of amounts that go in there. So it's the cost of company less any bonus or provident fund payment plus leave pay and bonus accruals. And then I've got a little spiel at the bottom, or a little story at the bottom. That's what spiel means, if anyone wants to know. So I've got a little spiel at the bottom that talks about the key personnel and how much they're getting paid and how much bonuses they're receiving. So that's basically just to show that would be separately identified and separately written out. So now with disclosure, you guys can see that the disclosure, it's not super hectic. So, but it's important that we sort of that we're aware of what needs to happen. Okay, so now we're going to go over and talk about post-employment benefits. So far we were talking a lot about short-term employee benefits. Now we're going to talk about post-employment benefits. So post-employee or employment benefits it basically means that the amount will only be paid to the worker after the worker has stopped working for the company. That's what it all boils down to. Okay, so it's the amount that's going to be paid only after the worker has stopped working for the company. So what creates this amount? The amount is created by the fact that the company allowed the worker to work for them. So the originating obligation, the obligation that gave birth to this amount is actually the service rendered. As a result, when the service is rendered is when we need to record these amounts, okay? So in the year that the service is rendered is in the year that we're going to record our liability for this amount or our payment of these amounts. Okay, now in terms of the term, like I mentioned, under so if we look at similarities versus differences between short-term and post-employment benefits, what we find is that both of them relate somehow to services, right? Both of them relate somehow to services rendered, but the one is paid 12 months after the year in which the service was rendered, right? So remember we had that diagram where we showed you the service is being rendered in 2021. So if the amount is paid before the end of 2022, then it's still considered short-term. So that's short-term employee benefits. But with post-employment benefits, the benefit is only paid after employment has been completed. And generally, we assume that that's going to take more than the 12 months after the period. So as a result, post-employment benefits generally is more on the longer term type of benefit. So that's one of the reasons why we have to split it and record it differently, because in essence, it's a different type of expense, different type of thing. Okay, and remember what we spoke about previously, where we said termination benefits is something else, right? So termination benefits, the obligating event is the fact that the worker is being terminated, is being let go. Okay, so those are the main three that we're going to look at, or that we've looked at. So there's two big types when it comes to post-employment benefits. The one is contribution, defined contribution plans. The other is defined benefit plans. Now, I specifically stressed on those words, contribution versus benefit, because I'm going to explain the difference. When there's a defined contribution plan, the company is obligated to give a contribution to some sort of firm or some sort of fund on behalf of the worker, right? So the obligation is a contribution. With a benefit plan, the company is required to provide a benefit post-employment. Now, how is that different? If the company says, when you start working, the company says, okay, every month we're going to give 500 Rand to a provident fund on your behalf. That's a contribution, right? That's sort of what we read already. But if the company says, when you retire, I'm going to pay you 1 million Rand, that's a benefit, right? Because now they're not talking about what happens between now and retirement. They're talking about what you're going to get at retirement. Okay, so that's a benefit plan where companies can sometimes promise you that we're going to give you this amount of money when you retire. Okay, whereas what we see more often is a contribution where they say we'll give 500 Rand, but whether that 500 Rand is used correctly by the fund that we give it to, or whether that 500 Rand is squandered, is sort of not our problem, right? Because they're not guaranteeing the benefit, they're only guaranteeing the contribution that they're going to give, that being the company. So contribution plans are an obligation to give a contribution, and benefits are an obligation to give a benefit. Now, what are the main features of a benefit plan? Benefit plans, firstly, are not going to be considered in our module. It's not super important for our module. But at a basic level, you need to understand the differences, okay, between a contribution plan versus a benefit plan. Okay, so a defined benefit plan, firstly, the risk of the amount changing over time is lying with the employer, so the company, right? Because the company is guaranteeing the benefit at the end of the end of employment. So whatever happens in the economy between now and the end of employment becomes the company's problem. Okay, so because the company has said, I'm gonna put away 100 Rand a month for you, and when you retire, you're going to get 1 million Rand, right? So they guaranteed the benefit, okay, 1 million Rand. Whatever happens to that 100 Rand per month is not the worker's problem, because he is here for the benefit. He is here for the 1 million. So the risk, the market risk, the credit risk, the inflation risk, all of those risks actually lie with the employer or the company, right? And the worker can rest easy because he knows he's getting a fixed amount, a fixed benefit at the end of his employment. Okay, so that's the first thing. The first thing is the risks. The risks all lie with the employer or the company. Okay, the next one is the legal form. So under a contribution plan, the contributions are paid into a fund, what they call a fund. So that's why you see pension fund, contribution fund. So that it's paid into a fund, which is basically a company that invests the money for you, right? So that's what a fund is. With a benefit plan, it has to be a separate legal entity. So it has to be a company that is generally set up by the employer, right? So it's set up by the employer, and it then does the investment. So can you see, because investing is such a specialized field, it's not very, it doesn't make a lot of sense for companies that are doing manufacturing or doing mining or doing whatever, to now have to set up a subsidiary and now manage that subsidiary, and that subsidiary is actually a pension fund. It doesn't make sense, right? So what we find is that benefit plans are not very popular out in practice. The main thing that we see in practice is contribution funds, contribution plans at least. So when it comes to the usage of the monies that are in the fund, the employee or the worker can only use it for the purpose that it has been designated. So obviously we're talking about retirement. So the purpose that it was designated for generally is for retirement. What you will find is sometimes your parents or your friends might be saying, oh, I'm going to cash in my retirement. I'm going to take my retirement out. I'm going to buy a car. I'm going to go on a holiday, whatever. That is not allowed under a benefit plan, right? You can't cash in until you retire. The only time you can get access to the money is when you retire. So the usage of the funds is very limited in a benefit plan, okay? So then if we look at what a contribution plan is, again, the company is only liable for the fixed contributions. There's no legal obligation to a specific amount of assets or benefit or money at the end of the employment. So whatever is left is the workers, whether it's 1 rand or it can be 10 million rand. It's not the company's problem. So the burden of risk then, so the market risk, the inflation risk, all of the different types of risks, the credit risk, all lies with the worker. The worker takes the assumes the risk. In terms of journal entries, the journal entries are very similar. We've already passed them when we're doing short-term employee benefits. It's just going to be a debit to an expense. In the past, we were calling this expense post-employment benefits. Now we're going to start calling it defined contribution plan expense, right? So it's just a change in words. And then we're going to either credit the fund, so it'll be provident fund, pension fund, or we're going to actually pay the money out, so it'll be credit bank, right? So that's basically the journal entries. The other thing is we're not accounting for any risks. So we're not going to account for any changes in the market. We're not going to account for any changes in the exchange rate, in the changes in inflation. That we don't account for. So there's no what we call actuarial gains or losses. The word actuarial just means accounting for the risks, right? So there's no change in the risks because the company doesn't assume the risks. The worker assumes the risks, and therefore we don't need to account for it. Okay, now what we're going to do, so this is the same, I'm just talking a little bit about disclosure. It's the same sort of thing that we already saw. In this amount here only goes the employer or the company's contribution, whereas in the short-term employee benefits is the employee or the worker's contribution. Okay, so this slide is just reiterating what we discussed. Now, very quickly, we've got it's literally going to take us like 4 or 5 minutes. So I know we're a little bit over time, but let's just quickly go into our blue book. So the book that's on the camera now, and we're going to look at 11.2. So very quickly, it's not going to take us long. I know that you guys are probably pretty tired, but I swear it won't take long. So we're going to go to 11.2, and there we're just going to pass a journal entry for this type of transaction. So I'm going to read it very quickly to you. So you guys, if you want to turn to page 138 in your blue book. So 138 in your blue book, it reads required, record the employer's contribution. So because it's told us employer's contribution, we know that our debit is always going to be either what we used to call it previously, post-employment benefit, but now that we learned the new term, we need to call it a defined contribution plan expense, right? So our debit is going to be that because it's the employer. Remember, if it was in the employees, then we might need to call it short-term employee benefit. But now, because it's the employer, we know that it's going to be defined contribution plan expense. Okay, so it says, let's read that again. It says, record the employer's contribution to the defined contribution plan in the general ledger of Acts Limited for the year ended 31 December 2020. It says for each of the following cases. Now, for each of the following cases, the first is, it says 50,000 Rand is paid, right? Then it says 150,000 Rand is paid. Now, in my textbook, I wrote a small note here and I said, this is very strange under B, right? Because B says 150,000 Rand is paid. That's very strange because a company generally does not pay an expense that is not due, right? The companies want to keep, you know what, cost management, they want to keep the money for as long as possible. But in this example, they're paying it before it comes due, which is a little bit strange. But anyway, let's just run with it. And so if we look at the information, it says Acts Limited made a contribution to a provident, which was classified as a defined contribution plan of 6% of the total remuneration paid to employees. Now, note, all of the examples that we deal with in Back to 100 are going to be defined contribution plans. I am not going to give you a question on defined benefit plans, only contribution plans. So in your textbook, you need to ignore the section on defined benefit plans and the section on determining the difference between the two. So only what we've done in class is what you guys should be able to explain to me, okay, in an exam or test. Okay, so the salaries is 1.5 million, and then the wages is 800,000. When we add those two amounts up, we get 2.3 million Rand. And then if we apply a contribution of 6% to the 2.3 million Rand, we're going to come out with 138,000 Rand. So that's the expense. So let's raise the expense. Debit, defined contribution plan expense. That's a P&L account. It's an expense account for the amount of 138,000. Then we're told that in part A, 50,000 is paid over to the fund. So we're going to say bank 50,000 because money is leaving the company. 50,000. So it's going to be credited, right? So bank credit 50,000. Then the remaining amount is going to be payable. So we're going to create a liability. We're told in the question that it's a provident fund. So we can create a liability called provident fund payable. Notice how when I compose the names for the accounts, I looked at my question, I looked at the information I was given, and then we compose the names, right? So that's what I expect you guys to do in the test exams, right? So it's provident fund payable, and that's a liability account. It sits on the balance sheet, and that's going to be the remainder of the amount. So it's going to be 138,000 minus 50,000, and that's going to give us 88,000. Right, and that's going to be what our liability is going to be. Now, why did I say that B of this question, portion B, part B of this question, is so strange? Look at the next journal entry. So the company owes 138,000, but they pay 150,000. Very strange. Companies never do this, right? So I think the examiner here was just trying to test, you know, does this person know that we shouldn't be paying this amount? That's what I have to conclude. So again, we raise the expense to an account called defined contribution plan expense, P&L account. We're going to debit that account, and we're going to debit it for an amount of 138,000. Then we are going to have our credit bank 150, which we are told. And then the balancing figure is going to be an amount that is going to be an asset. So if you look at the question that's on the screen, you're going to see I'm going to underline something. And what do you think is wrong with that part of the account name? What do you think is wrong? Type in the chat what you think is wrong with that part of the account name. So yeah, I underlined it, the payable part. Nothing else in the question told us that there was an amount outstanding, right? So we can assume that because nothing in the question told us there was an amount outstanding, the amount was 0. When you're debiting an amount, you can't debit a payable amount and still call it payable, okay? Because if you debit a payable amount that's 0, right, and now you're debiting it with 12,000, it's now going to become what we call a receivable. It's an asset, okay? So this, I believe, should have been so this payable here should have been receivable. That's because it's an account that was previously like 0, and now we debited it with 12,000 rand, so it should be an asset. Okay, so we would, when we're composing our accounts, we would say receivable. Okay, so any questions about post-employment benefits and specifically our defined contribution plans? Any questions? You're welcome to pop it into the chat. Yeah, so that's basically our lecture for today. For tomorrow's lecture, very important. I know that most of you guys are going to want to come to tomorrow's lecture because of the homework, right? So make sure that you come to tomorrow's lecture because the homework is happening. But also, please go over 11.7. That's 11.7 in your Test Your Knowledge of Accounting workbook. So 11.7 in the blue book is because tomorrow's lecture is just going to be basically going through 11.7 very carefully. Yeah, so that's it. Thanks, guys, for coming. All the best for your Thursday evening, and I hope you have a good one. I shall see you back tomorrow. Oh, one more thing. In tomorrow, you guys are going to join the same link. So there's only one link on a Friday. Remember, I told you that right at the beginning. There's only one link on a Friday. You're going to join the same link as the group 1. You're just going to join it at your allotted time, which is, let me find your time, which is 10:30, right? So you're just going to join at 10:30. Yeah, that's it. All the best. Have a good time. Bye-bye.